Welcome to PlotLines, where I'll use my years of experience in real estate communications to uncover the real stories behind real estate. I'm Britni. Join me as I invite guests to break down the headlines in the real estate market. All right, welcome back to PlotLines. Today I'm thrilled to have Paul Fiorilla, the Director of Research for Yardi Matrix. Paul, thanks for joining me today.
Thanks. It's a pleasure to be here.
Yeah. Well, why don't we get into it? Tell us a little bit about yourself and your role at Yardi.
So I am the Director of Research at Yardi. I have been here almost 12 years. So Yardi is a big software company. You know, they're the leading provider of property management software. About 12, 13 years ago, they bought a multifamily data firm that was based in Scottsdale, and that became Matrix. So Matrix hired me to oversee kind of a research operation, and I've been doing that ever since. We publish a wide range of research publications, monthly, quarterly, biannual, national multifamily outlooks. We now publish regular reports and a lot of different property types. And I also represent Matrix in the industry. I'm, an active member of a lot of trade groups, National Multifamily Housing Council, the Urban Land Institute's Affordable and Workforce Housing Council, the Pension Real Estate Association, NACREIF. My role is kind of a public one at the company representing Yardi in the industry.
Yeah. Amazing. Well, then you sit in a really great seat to be able to help us break down some of the things that are happening in the industry. So I'm glad to have you. So again, the PlotLines show is all about sort of navigating and rewriting headlines in the real estate space. So I want to talk a little bit about what's happening in multifamily. We're seeing a lot of headlines suggesting multifamily recovery in 2026. But we're also seeing things like supply overhang, demand side drag. I mean, there's a lot of different sort of taglines being thrown around. So from your seat, tell us, what are you seeing? And are these sort of buzzwords that we're seeing in the news, are they accurate? Are they getting it right? Are they getting it wrong? I'm curious to hear your take.
Sure. Well, there are different narratives.
Yes.
And it depends to a large degree on where you sit, literally, because, there are different fundamentals or different parts of the country right now. But I mentioned being with trade groups. I with a call of researchers in one of the trade groups I was on a couple of weeks ago, and there was kind of a debate about the narrative between the kind of the glass half empty side and the glass half full side. So,
yeah.
The glass half full side will say, look, multifamily rent growth has been weak for the last few years, and a lot of that has to do with too much supply, and the number of starts has dropped pretty significantly over the last few years, about 30 to 40%, since the peak in 2023. So what we're going to see is nationally starts are going to go from, 500,000 or whatever they were to about 300,000. And if demand remains healthy, then we're going to have another shortage of apartments, like we had a few years ago, and rents are going to go up again. Nobody's suggesting rents are going to go up like they did in 21, but we're going to start seeing very soon, we're going to start seeing normal rent growth, maybe by the end of this year. And, the class F empty side is saying, look, starts are down, and our data, Yardi is one of the main data providers in the industry. We're showing starts are down too, but deliveries are not going down as fast as kind of the optimistic scenario hopes or expects. So our forecast for multifamily deliveries was like 700,000 a couple of years ago, and we expect it to kind of bottom out this year and the next couple of years at about. So that's less than it was, but it's not nearly as low as maybe, some people might be hoping for to create kind of another shortage. And the other part of that is the demand side, right? Demand coming out of the pandemic, we had like amazingly strong demand. And that was one of the factors why rents went up, almost 25% over 2 years in 21 and 22. But since then, rents have been flat, up maybe 1% per year over the last few years. And this year, rents are kind of in that same range through the mid-year. If demand remains strong, then we'll start to fill up. So I mentioned the supply overhang. There was a lot of supply, and there's a lot of properties that have finished that are still in the lease-up phase. There's maybe almost twice as many units in the lease-up phase now than there are historically. So our data, we track about 1.2 million units that are in the lease-up phase, which means that apartments have a lot of competition, especially in, these high growth areas. So it's going to take some, the other narrative, which is kind of the narrative that I subscribe to, is that it's going to take a little bit of time to fill all those units that are in the lease-up phase. And, maybe the second half of 27, maybe into 28, our forecast for rent growth is, about 1% over the next, this year and next year. And then we don't forecast rent growth picking up to more normal levels until 2028. Now, the other part of that is that's like big picture national number. When you break it down, there's been in recent years a big regional difference. So rent growth has been moderately strong consistently over the last few years in the Northeast and the Midwest, generally speaking. And the Sunbelt and the Mountain West, kind of those high supply markets where there's a lot of growth, but also a lot of supply. Those markets had a huge, run up in rents in like I said, in 21, 22. And then they've been negative for the most part, not every market, but for the most part, most of the Sunbelt has seen, negative rent growth over the last 2-3 years. And, they're the ones that have the huge overhang of supply. New York, Chicago, San Francisco never saw that big run up in supply. So there's still, relative balance between supply and demand over the last couple of years. San Francisco, was really weak for a few years. San Francisco is like the one market that did not see a big run up in rents. And it's starting to run up now because they've, because of AI and the booming, the spending in tech, that market has become, it's now the leading metro in terms of rent growth over the last year and a half.
Interesting.
So when you talk about this narrative, it has a very big regional story. Throughout my career as a researcher, the number one question people always ask is, hey, what markets do you like? Right? All of us who do this for a living, that's like the question we get everywhere we go. Hey, what markets do you like? But, this year, starting late last year into this year, that's not the first question people ask me anymore. Now the first question everybody asks is, hey, when is rent growth going to come back to the Sunbelt? Right?
Yeah.
Because a lot of money chased, deals in the Sunbelt because that's where the growth is. And it's still a high demand market, right? That's still, when we look at absorption, it's still really high in the markets where rents are going down. But because they have that supply overhang, it's going to take some time before rents go back to kind of normal growth levels.
All right, Paul. So you walked us through a lot of the challenges that owners and operators are facing right now, from expenses to slower than expected rent growth. But walk me through some of the positives for the industry or opportunities that you see exist in the coming year.
Well, one of the big positives for multifamily is that it is very in demand from investors, right? Multifamily is a very stable, long-term asset. People need somewhere to live, and whatever's happening, with current supply and demand, it's it's considered a very safe, and when you look at investor surveys, multifamily is consistently the number one property type right now. So there's a lot of liquidity both on
Yeah.
the equity side and on the
Hmm.
debt side for multifamily. Other property types within commercial real estate uh, all have problems. There aren't any, I'm talking a little bit about kind of the current difficulties of multifamily, but compared to other property types, it's not quite as bad. Office just went through, the work from home, the existential crisis about, values dropped 50% or more on a lot of properties. The question about office is, is it at the bottom or not? Retail has, it went through a very
Yeah.
long, it went through its existential crisis 20 years ago, and it's still not recovered fully. It's fine. Office retail properties right now are performing well. There hasn't been a lot of construction in retail,
Yeah.
but, it's not a high growth sector, and a lot of investors are still avoiding it. Industrial is great. Industrial just went through the last 10 years where it became a much bigger part of the, institutional investment landscape. But at the same time, rents went up a lot over the last 10 years. There was a lot of industrial construction. So all the easy money in industrial was kind of made in recent years. And again, it's fine. There's nothing wrong with industrial right now, but a lot
Hmm.
of investors are starting to think it's been a little bit too heavily invested in. There's a lot of niche sectors that are good, but they're small and they're also kind of volatile in terms of performance. So then you have multifamily, right? So multifamily has been really, really strong. And then when you look at what kind of investments as a multifamily investor, what do you want to invest in? Getting back to kind of what I said before, like people asking me, what's the best market? That's not how you should look at things anymore. Right now, you have to, drill down to the submarket level. You have to drill down to the investment type category. Maybe you want to invest in sort of high yield debt. Maybe you want to invest, you have to find, particular submarkets that are still growing. The Sunbelt, there's generally, and rents have been flat and they're going to stay weak, but there are markets within each of those larger markets. There's submarkets within those largest markets that are performing well. There are, maybe it means going into like a slightly smaller market. So,
Hmm.
people, we had this has been happening for decades, but after the pandemic, we had another wave of migration away from high cost markets to kind of lower cost
Sure.
markets.
Yeah.
Well, those lower cost secondary markets are not as cheap as they used to be. So you see people, you see population, you see demand kind of migrating to kind of satellite markets outside of secondary markets. So like, instead of Austin, maybe Killeen, Texas, or, different, markets like Sacramento, years ago, Sacramento instead of
Hmm.
San Francisco.
Okay.
So there's that kind of, you have to be looking for specific opportunities, just not thinking about the big picture.
Hmm. Hmm. Yeah, that makes sense. I want to shift gears a little bit. You mentioned AI earlier, and AI, of course, is all the hype and everything, but certainly is bleeding into real estate as well. Where do you see AI impacting or not impacting multifamily? What sort of role do you see it playing from your seat, or that you've been hearing?
AI is going to be a big part of the economy going forward.
Yeah.
When we look at business investment, hundreds of billions of dollars are being invested in AI. It's like the biggest source of business investment right now. The impact downstream, we're just really at the beginning of that. In terms of real estate fundamentals, and you look at it, are companies, going to need less office space? Are they going to hire less? If they hire less, that's fewer jobs, less demand for multifamily. There's different schools of thought on that with some people saying, you look at AI, it's going to transform how we work, even people like me, my job. And it's, companies are going to have, hire 50% fewer knowledge workers. And then you say people, well, you look at the history of technology, and whenever one technology, grows, it does take away some jobs, but then it creates other jobs in, different parts of that field. So, AI is still new, and it's going to definitely have a major impact. I think we're still not sure what that impact will be. I mean, my view looking at, those two scenarios would probably be somewhere, it's going to have an impact, but I don't think, companies are just going to have 50% fewer employees. I just don't think that's the way it's going to work. But I don't know, and then when you look at it as a technology, I mean, Yardi being a tech firm, and I'm not a technology expert. I'm kind of a real estate person at a big tech firm. But we have integrated AI into our software products. We have an internal AI product called Virtuoso that interacts with all our software systems. We're integrating. We will be integrating Virtuoso into Matrix, which will help do research from within Matrix if you're a subscriber to Matrix. And we've also integrated a Claude connector, and that's our clients. Some of our clients have talked about how impactful that is. So again, I'm not the best person to talk about all the details, but I mean, I do know that it aids with efficiency, and and I was talking before about cutting expenses. I mean, you can use those kind of AI tools to reduce your count for like customer service jobs and different kinds of things. So it's definitely transformative. Will it affect multifamily demand? I mean, I think we're still kind of years away, at least 5-10 years away before we start seeing the impact in terms of, actual demand for housing space.
Sure. Yeah. Makes sense. All right, Paul, we covered a lot of ground. Is there anything that we didn't hit on that's top of mind for you right now, or Yardi in general?
I mean, I guess, just, it's really important to know your local market. It's really important to not get over your skis in terms of, leverage or, getting into areas where you don't have expertise. I mean, one of the, the questions you sent to me and, before the interview was you asked me about the debt situation, right? I think you were wondering. So like one of the areas of an opportunity for multifamily, one of the major areas we're seeing for deal flow is, restructuring loans that have been extended, that are underwater. They're not exactly fully non-performing. They might have, be cash flowing, but in order to refinance them, the owners have to put up more equity, which maybe they don't have or don't want to put up. And banks don't really want to foreclose. Yeah. So what you have is kind of, this slow unwinding of loans that were originated in 21, early 22 before rates went up, loans that have like a 3-4% coupon. And now rates are, 5-6%, 7%, depending on, the leverage. And so they're underwater from from a proceeds. If you had a loan that, qualified, say for 10 million, 5 years ago. Maybe now at the same amount of a debt service level, you might only qualify for $8 million.
Okay.
And so there's if you refinance, you got $2 million to fill in. So there's a lot of private equity capital that's out there that's looking for ways to invest in those kind of properties. In some cases, banks are, kind of wanting, banks definitely want to get those kind of loans off their books. But again, they don't want to take losses, so they've been stringing them along. There's a lot of capital out there looking to repair those kind of deals and work with banks. That's another area of opportunity. And, it's been a slow unwind over the last couple of years. And, I think it'll continue to slowly unwind. I don't think you're going to see any like big news stories about, a bank selling $1 billion or $2 billion of defaulted loans. But, there's going to be those, there are a lot of loans that will wind up getting, worked out. And there's a lot of, investors that are, maybe because, there isn't I think I mentioned at the beginning, there's, a lot of transaction activity has been kind of weak. And so if you want to invest in multifamily, one way to do that is to do it through debt investments. And there are literally hundreds of private equity vehicles that are, scouting out these kind of opportunities right now.
Okay. Interesting. All right. Well, we started the show talking about headlines. And so I always give my guests the opportunity to write their own headlines. So if you could see anything out there about multifamily right now, what would it say?
I started my career as a journalist, and I was never really great at headline. There are times when you have to write headlines, and I was better at writing the stories than I am at writing the headlines. But that's actually a skill. And if you look at the news out there, it kind of reminds me of one of the more famous headlines in American journalism history. Back when New York City was having troubles, and the Daily News wrote the headline, Ford to City dropped dead. And, we look at, the news about, money being cut for things like the Gateway project between New York and New Jersey, and, aid to, being cut off to, to cities like New York. And, I kind of think of something like, Trump to cities drop dead, but that's not really specific to real estate. So just look, be careful. Just know what don't overextend yourself, and know your market. I think those are kind of the big things right now. Things will get better. Might take a few quarters, but I think the market will pick up.
Okay. Stay patient a little bit, maybe.
Yeah.
Okay. All right. That was great. Thanks so much for joining me, Paul. I really appreciate your time today.
This podcast is a production of Gregory FCA. If you enjoyed our discussion, please subscribe wherever you listen to podcasts